All right, let's go forensic. We are digging into one of the most talked about, most dramatic market meltdowns in recent memory, the great Bitcoin collapse of 2026. What was really going on behind the scenes? Well, we're about to find out.
Okay, let's start with just one number, because it really tells you everything you need to know. 50%, a 50% drop from its all-time high. I mean, that's a brutal haircut that completely vaporized billions of dollars and just reset the entire game.
And what's absolutely wild is how fast it all happened. This wasn't some slow, painful grind downwards. No, this was like driving off a cliff. That entire 50% collapse took place in just 3 months. 3! It was a lightning-fast, violent unwinding that caught almost everybody completely flat-footed.
So that's the big question, right? The headlines were all over the place, blaming everything from tech stocks to Fed policy. But the real story? Well, the real story is so much deeper, kind of hidden in the plumbing of the market itself. It wasn't just one thing, and believe me, the actual triggers were way more interesting than what the news was telling us.
Okay, so first things first, we need to set the scene of the crime. Let's walk through exactly how this whole thing went down, step by step.
The speed of this thing was just breathtaking. Think about it. In October of 2025, Bitcoin is on top of the world, hitting a record high around $126,000. By November, you start to see the first little cracks in the armor. Then, in January, the market tries to rally, but it just fizzles out, no momentum at all. And then, boom, by early February, we've hit the bottom in the mid-60,000s. I mean, a complete round trip, from the absolute peak to the trough, all in the span of a single quarter.
You know, any good investigation starts with the most obvious clues, right? The usual suspects. And for traders, the warning signs were flashing bright red on their charts long before the final collapse.
So back in November 2025, the market got hit with this classic textbook bearish signal, the death cross. And yeah, it is exactly as scary as it sounds. The 50-day moving average, that's the short-term trend, plunged right below the 200-day, the long-term trend. For anyone who lives and breathes charts, this is like a giant screaming alarm bell going off.
And you know what? Some people absolutely saw this coming. As that death cross was forming, a trader named Cameron Faust was already telling his followers, hey, a bear market has started. He was even mapping out where he thought the bottom would be, way out in late 2026, all based on what he'd seen in previous cycles. The writing was on the wall.
Okay, charts are one thing. They show you sentiment. But if you really want to know what's going on, you have to follow the money. And for that, we look at the on-chain evidence, the forensic data right on the blockchain itself. This is where we see what people were actually doing.
And this right here, this is the smoking gun for intent. The on-chain data showed this massive rush of Bitcoin heading to exchanges. We're talking nearly 10,000 Bitcoin, worth almost $1 billion in just a 72-hour window. Now look, you only move your coins from secure storage onto an exchange for one reason. You're getting ready to sell.
And this is where things got really nasty. This wasn't just people deciding to sell anymore. It became a machine. As the price dropped, it triggered a domino effect of forced liquidations, over $2.5 billion worth of leveraged positions getting automatically wiped out. This is like pouring gasoline on a fire. It's forced selling that shoves the price down even harder, even faster.
But here's the thing. All of that, the scary charts, the forced liquidations, those were just the symptoms. That wasn't the disease. The real story, the actual motive behind the crash, well, it lies in 3 key numbers that show us who was really behind all that selling. And let's just say it wasn't who you probably think.
These 3 data points, when you put them together, tell a fascinating story. A story that goes way beyond just a simple retail panic. They show a huge, fundamental shift in how the biggest players in the game, the institutions, Wall Street, were acting. And their behavior is what really tipped the scales. Okay, this one is huge. For 21 straight days, Bitcoin was significantly cheaper on Coinbase, which is where the big US institutions do their trading, than it was on global exchanges, a negative premium. What does that tell you? It tells you with crystal clarity that US institutions were selling. Not just selling, but selling aggressively and persistently while the rest of the world was actually trying to buy.
At the same time, look at this. $14 billion just vanished from stablecoins. And this is so important. See, when investors sell Bitcoin for stablecoins, that money is still sitting on the sidelines, inside the crypto world. But when they cash out their stablecoins for actual US dollars,
That means they've packed their bags and left the party entirely. This was a mass exodus. And here's the why. Why did all that big money leave? Well, for years, hedge funds had this amazing little trick called the basis trade. It was basically a low-risk way to make money off price differences, and at its peak, it was kicking off a juicy 17% return a year. It was like free money. But by early 2026, that return had collapsed to less than 5%. The free lunch was officially over. So the hedge funds packed up, unwound their trades, and billions of dollars in demand for Bitcoin just evaporated.
So let's put all the pieces together. The charts broke down, the liquidations cascaded, and the big institutions led the stampede for the exits. So what's the final verdict here? What does this whole mess tell us about what Bitcoin has really become?
You know, an analyst at investing.com really just nailed it with this quote. The crash wasn't about some secret manipulation or retail investors panicking. It revealed something much more fundamental. Bitcoin was now playing by Wall Street's rules. It had become part of the very system it was supposed to replace.
And that really gets to the heart of it, this identity crisis. The theory, the dream, was that Bitcoin was digital gold, a safe place to park your money, held by people with long-term conviction. But the reality, which this crash exposed, is that it now acts a lot more like leveraged tech, a super volatile asset tied to the hip of the stock market and traded by institutions chasing quick profits, not a financial revolution.
And so we're left with this really uncomfortable question. Bitcoin finally got what so many people wanted: Wall Street adoption. The big money came in. But in gaining all that capital and all those complex trading games, did it accidentally give up its soul? Did success kill the revolution? That's the question the 2026 crash forces us all to ask.